Hello everybody, my name is Mansoor Sohail. You may call me Manny for short. I'm an accountant operating out of Scarborough, Ontario, and I specialize in taxes for Canada and USA. My today's presentation is for educational purposes only. I will be talking about risk associated with ETFs and how can you diversify. Financial losses usually come from volatility in the market. There is no way that anyone can make money in investments without accepting some kind of volatility. Usually, stocks and real estate ETFs are more volatile than bond ETFs. Short-term bond ETFs are less volatile than long-term bond ETFs. International ETFs are more volatile than US ETFs, and emerging market ETFs are more volatile than international developed market ETFs. ETFs cannot eliminate following symmetric risks: market risk, interest ratio risk, inflation risk, political risk, and natural hazard risk. Standard deviation is a good measure of risk for stocks, bonds, mutual funds, and ETFs. It measures the degree of past bounce, and from this measure gives us an indication of future bounce. Beta is another measure of volatility that tells us if S&P rises or falls by X%, then our investment will likely rise or fall by Y%. S&P is considered our baseline and it is assigned a beta of 1. There are two different ways in which you can make your portfolio. One method is a division of stock portfolio into domestic and international, and then in a different style such as large cap, small cap, mid cap, value, and growth. The other method calls for allocating percentages of a portfolio to various industry sectors such as healthcare, utilities, energy, financials, and so on. As a rough rule, if you have about $50,000 to invest, you should not have more than 10 ETFs in your portfolio. And if you have about $250,000 to invest, you should limit yourself to about 25 ETFs. Large cap companies are with more than $5 billion in capitalization. Mid cap companies are with about $1 billion to $5 billion capitalization. And small cap companies are with $250 million to $1 billion capitalization. Anything from $50 million to $250 million is usually considered a micro cap. It is a good idea to have 50 to 70% of value and growth stocks of large companies in your portfolio. You should always evaluate each and every investment you make in context to your entire portfolio. Usually, lower the PE ratio, the more valuable is the stock. Value stocks will always pay dividends. Value stocks will usually be found in energy, banking, and transportation industries. Value stocks outperform growth stocks because of the greater dividends paid by value companies. Growth companies, they like to reinvest their cash in acquisition and new development. The best way to invest in large value is to buy index through ETFs. You should always look at expense ratio, appropriate index, and tax efficiency in picking a large cap value ETF. I have gathered this information from the book Exchange Traded Funds for Dummies, which is written by Russell Wild, who is a NAPFA registered financial advisor. Thank you very much for watching.